You gotta be flipping my flapjacks. $3.9 million plus public count right back to unbelievable. The move on Friday, obviously. A lot of things I want to react to in this video. One of the first things I'll react to is, do I believe in the rally we had on Friday? Do I believe that's sticking? Do I believe this is going to continue for quite a while? Those sorts of things, okay? So I want to speak about that right off the top. I mean, the moves were insane, right? Honest stock was up over 11% on the day. SoFi was up over 7%. Revolve RVLV was up over 6%. Estee Lauder up over 4%. And I had a ton of stocks up 2-3%. And everything was going so perfect. Even Duolingo put options made me money. Duolingo stock must have been probably the only dang stock in the whole market that crashed while every other stock was going up. Like literally, like everything is working in my favor, right? Duolingo stock down 4% on the day when everything else was blasting higher, right? And so I also want to talk in this video toward the beginning about kind of this sort of notion out there, right? Rising subscriber numbers are one of the clear signals that a platform is improving and becoming more relevant. Duolingo, the numbers, the growth they've shown there, like, is it real, right? Is it lasting? I want to speak about that in this video and kind of give a little bit of a warning out there as somebody that's been in this market for a long time. It's not saying a lot of companies become the big things and then falter, right? Tom Lee was on CNBC yesterday speaking about his views on the market, so looking very forward to react to that one. The Professor Jeremy Siegel, he was on CNBC yesterday speaking about his views on where the market's headed from here, so looking forward to reacting to that one. Oh man, we got the Dean of Valuation, Ashwath, talking about markets will move higher until risks show up in earnings in the economy. Looking forward to reacting to that one, sharing my opinions and perspectives there. So yeah, action-packed video, folks. Only one thing I need from you guys, hit the like button. If you could just please hit that thumbs up button, that's all I need from you. Please do that for me. Additionally, if you want to be subscribed to the channel, you can certainly subscribe. I think we're over 106,000 subscribers on the reaction channel. And I'm back home, back in Vegas. Thank goodness. I don't want to go anywhere for a while, man. I've been doing so much traveling. I was in Mexico, then I was in Georgia, then I was in North Carolina, I was in New York City for quite a while, then I was in Arizona. I'm just happy to be home, okay? Listen, guys, the first time I'm going to announce this big deal we got coming up 8 days from now, September 1st, Labor Day. We're going to do a one-day sale for my highest end Patreon tier. That Patreon tier is usually $125 for access to that one. That's access to my Become a Master Stock Market course, as well as the moves I'm making in my Patreon portfolio each week. Plus, you get access to that particular Discord chat there, the Stock Hub Discord chat. So yeah, if you want access to that, that will be the pinned comment down there here today, and we'll send over the deal when it drops 8 days from now, okay? So, before we get rolling here, what's my feeling on the market? Do I think Friday's move was lasting? Here's my take. I distrust it. I distrust it meaningfully. Here's why. Many times, I've been in this market 17 years, watched so many of these Fed presidents speak, right? What I see a lot is Fed president will come out and say blah, blah, blah. Market will make a move, big move many times, up or down, okay? And then a trading day later or two, all of a sudden you get like the real reaction. And so a lot of times you cannot trust the initial reaction. Same way as if the market went down big, I wouldn't have trusted that either. Like if the market was down big, I wouldn't have trusted that and been like, this market might come snapping right back. And so when I see the market have that insane rally day on Friday, I'm like, I don't know if I trust it, man. I'll just be completely honest with you guys, right? But I also kind of am a little worried about us having like a melt up rally all the way into that first rate cut, because everybody thinks it's going to like be skyrocketing after that first rate cut comes, and then I'm like, watch, all of a sudden after that we get a major down cycle in the market, right? So, I don't trust the whole. I don't ever trust when the stock market's moving upon what somebody in the Fed is doing. Never trust it. Never trust it, man. Because I've seen it before where, they signal this. And the other part I don't trust about this whole thing is I've listened to so many Fed presidents over the years, Janet Yellen, Ben Bernanke, Jerome Powell. I listened to so many of these folks. And what I witnessed with Jerome Powell on Friday was not a super dovish Jerome Powell. Like, I just walked away feeling differently than I guess Wall Street was feeling. Like, they made out like he's like the most dovish man ever. He's about to cut 100 basis points here. I just walked away not feeling that. I felt like that was a man still weighing all his options, right? He left the door open to rate cuts, but I don't know, man. It wasn't as dovish as the market took it in, at least in my personal opinion. So the whole situation's weird. I don't really trust it. Would it be shocked if the market got hit this upcoming week? I wouldn't be surprised. Like, a lot of times the market does the opposite of whatever that initial move was. And so, like, if the market faltered this week, I wouldn't be surprised at all. On the flip side, if we rally all the way into the September cut, I'm going to grow very skeptical. I'll grow very, very skeptical. I'll need to, hedge up a little bit more, okay? Now, Duolingo little dingo. What's going on here with this stock, right? There's clearly an issue. When you got, like, it seems like every stock in the market going up, and then Duolingo little dingo goes down 4%, I would be a little concerned about that. Anytime a stock's that weak when the market's that strong, I'd be like, what's going on here, okay? So here's an important factor that you got to take into account. As somebody who's been doing this for 17 years, how many people have been picking stocks for 17 freaking years? It's ridiculous, right? Listen, I watched a lot of companies grow and become big in a very niche space, okay? GoPro was a good example of this. GoPro was growing revenues, 230 million, then they grew to $52 million, $98 million, $1.39 billion of revenue, $1.62 billion, and then they peaked, right? And at this time, it was like, oh, everybody's gonna want an action camera. This market's just so huge. Everybody wants an action camera. Everybody wants an action camera, right? No different than the Duolingo little dingo thing. It's like, everybody wants to learn a language. No, they don't. No, they don't, okay? And so eventually you reach a saturation point, even in these niche markets, and you just have trouble growing your business anymore after that. Look at what happened to GoPro's annual revenues, right? Today, they do $800 million. It's not like the business disappeared. It didn't go bye-bye. It wasn't like they went bankrupt and they went out of business. No, it's a very small business. It's a very niche business, right? Fitbit, another great example. Like, look at the Fitbit users, monthly active users over time. They went from 6.7 million, 14.9 million, 23.6 million, 29 million, 33.8 million, 38.3 million, 40.2 million, 41.5 million. And Fitbit, that was a device that, people were making an argument back in these days when they had that insane growth. People were saying, like, everybody's going to have a Fitbit because it's, it tracks all your health, and, like, why wouldn't you have a Fitbit? Every person on this planet's going to have a Fitbit eventually, right? And that was an argument that was being made. And when it had these insane growth rates, like, people believed it. Like, dang, yeah. They only have 15 million users. Everybody should have a Fitbit. They're going to go to 1 billion users or billions of users, right? And what do we know? Fitbit peaked. It peaked in a major, major way. Now, what happened to Fitbit's valuation? Well, back in the days when people were of the belief, like, everybody's going to have a Fitbit, or a huge amount of people are going to have a Fitbit, right? Fitbit's valuation was around $10 billion market cap on Fitbit's company, right? And fast forward a couple years later, $1.4 billion market cap. $1.4 billion market cap. Went from 10, stock fell 80+%. People are like, it peaked, right? It peaked. And it wasn't like actually users peaked at that particular time, because users actually kept going up for quite some years after that. But people were realizing, like, oh, this niche market is, it doesn't have much growth left. And that's when you get a major valuation, kind of re-rating in the stock, and it's brutal to go through that. Because the issue is you never come back. That's the thing, like, Fitbit never came back to that $10 billion plus valuation. If Fitbit was a public company today, a standalone public company, they ended up getting bought out by Google. But if they were a standalone company today, they might still be around, honestly. But what would their market cap be? $1, $2, $3 billion, something like that? It never would have gotten back to that $10 billion plus valuation it used to have back in the day, right? So that leads us to Duolingo little dingo here, okay? The stock's already been hit. The stock was at 500 something. We got the first initial scare, right? That sent the market cap down to where it is now in this $15 billion range. Here's the deal, okay? When we get the second scare with the stock, the valuation will fall, in my opinion, to $10 billion. And then when the third scare comes, $5 billion. That's my opinion. No, maybe I'm completely wrong. Maybe that never happens, right? Maybe it never gets scares. Duolingo dingo just grows to become a big dingo, and it just, everybody in the world wants to learn a language, and everybody in the world wants to learn chess, right? And by the way, from what I've heard, I've looked at a lot of reviews of Duolingo. It doesn't actually teach you very well how to actually learn a language. From the reviews I've looked at, people are like, it doesn't even, like, if you want to actually learn a language for real, don't do Duolingo, do something else, right? Now, in regards to this, I used to own a company named King Digital, right? King Digital was a game company. They made a fortune of money. Oh my gosh, did they make so much money. And they had all these very addictive, kind of like Duolingo, Little Dingo, all these very addictive games, right? Which Duolingo is kind of more of a game than actually learning, right? And Candy Crush, Soda Saga, and all these other games they had. Oh my gosh, Paradise Bay, and they had a bunch of these different games that were so popular, and their user growth was just astronomical, right? And then, like all companies, they started to reach a peak, right? And then they just started to slowly go down, and they can never recover over time, right? And, today, King Digital, it's owned by Activision Blizzard, which is now owned by Microsoft, right? And, it's still money-making business. It's not like it went under. It's not like it disappeared. And it's the same exact thing I see happening with Duolingo here, is I don't think they're going to disappear. I don't think they're going to go bankrupt. I just think we're going to find out very shortly here that this company's in a peaking process in 2025, and it will never come back to these sorts of prices. Now, with my put options, I don't actually need that to come true. That's the best part, right? That's just a hedge for my portfolio. Like, if the market gets hit at all, if Duolingo continues to get hit here, I make a bunch of money, I'm out my put options, cash those into long shares of other stocks, right? But I think the risk I'm telling you about here needs to be considered, because I see a lot of retail investors buying Duolingo stock heavily in 2025 this year, right? And I'm like, I'm just looking at the company, I'm like, this has all the markings of being another one of these type of companies. Now, the argument I've already made in regards to kind of like Fitbit and GoPro is those companies sold hardware products, right? I already made this argument, and it kind of frustrated me because somebody tried to debate my point. I'm like, I already made this point about like hardware companies are even extra hard because, like software is just easier. Like Duolingo has all these people on subscription plans. It takes a lot longer for, their revenue to falter and things like that. And so that's why I think Duolingo's in a better position than GoPro and Fitbit, but that doesn't mean their stock's not going to go down 50 or 70% over the next few years. So do keep that in mind, right? Now, here's the thing with Duolingo. And this should be, like, no one's talking about this on the bull side. And I think, like, this, you've got to take this extremely seriously. Their monthly active user number has started to decline. That's like in my opinion, that's the first signal of like, like this ship could be going down, okay? They went down to 128 million monthly active users. From the previous quarter, they were at 130 million monthly active users. That's the first sign, I believe, and I think this is also why the stock fell from the 500 range down to the 300 range now, of like, oh boy, I think this insane high valuation name is starting to peak here, right? And that's why people are already jumping ship on this one, because they realize the best days are likely behind Little Dingo here. But the sign number 2 that we just got, everybody should be freaking out about this. If you're long and you're just like acting like this doesn't exist, I can't see it, like this next part is even bigger in my opinion, okay? The social media guru of the company, the senior global social media manager, the one who really built this company into, like, why do they have all these users? It's because of this lady. This lady, right? They got the product, but at the end of the day, the product's only going to do so much for you. You've got to go viral on Instagram, TikTok, all the social medias. And this lady did one of the best jobs in modern history for marketing of a company. Absolutely a historic job. And she's gone now, right? She posted this 5 days ago on her LinkedIn page. So I'm leaving Duolingo after 5 unforgettable years, 8 billion impressions, and even more jaw drops. It's time to take off the suit. Fresh out of college in 2020, I led Duolingo's evolution into a social-first brand, turning organic social into a growth engine that drove waves of new users. Yeah, we can't debate that. She drove waves of new users. Like, the reason this company is so massive is because of her. Duolingo Social helped catapult the company's market cap to nearly 7x in just 5 years by breaking into culture as an unexpected disruptor It's been a privilege working alongside a phenomenal team that lifted me up and made the impossible feel routine. You all taught me how to fly and own my power every single day. As for what, why, who, when, and how, I'm saving all that for the book. I guess she's going to write a book someday, right? So yes, I'm no longer Zaria from Duolingo. I'll mourn that for a while. For now, I'm just Zaria. But then again, maybe there's nothing just about it. Adios, she says. Why would she leave? Why would this woman leave? You got to ask yourself that. I'm only coming up with one conclusion on why she would leave Duolingo. It's that she feels, which is my opinion, she feels like growth has peaked with the company. In that user numbers are going to be an absolute near impossible thing to keep going up. I believe she thinks the user growth is peaked, and it doesn't matter what she does on Instagram, TikTok. She's not going to be able to, keep up these sorts of numbers. And she wants to get out while the company's on top. That's my belief. I could be completely wrong on that. But I have been paying attention to stocks for 17 years and watching all these executives leave companies, come back to companies, right? Get hired, get fired. I've been watching all this. And so, like a woman like that, I'm like, I don't see her leaving. In my opinion, if she really thought this company could grow to 200 million users, 300 million monthly active users, 400 million monthly active users, I don't think she would have left. I think she would have kept on the ship and been like, we're just going to keep pushing. And remember, she just departed, was it August 15th? That's not usually a rash decision. Usually you're going to plot that out over several months. If you're somebody like her that's a senior, manager of all the social media marketing and all the marketing for the company, you're not just going to wake up one day and be like, I'm out of here. No. That's going to be a calculated decision that you'd likely consider for a few months. She probably my guess is she probably let the executive team know in July that she was likely going to end up departing, and then maybe she had a 2-week or maybe a longer than a 2-week thing, and then eventually she left, right? So my opinion is here, that woman probably sees that user growth is in a peaking process, and she doesn't want to. The last thing, she's got this insanely great reputation, right? Of she grew Duolingo to the moon. She grew it from such a small user base into this thing that had 130 million monthly active users. If they start going down on users, it's going to stain her reputation in a major way. If all of a sudden they go down to 120 million monthly actives, 110 million, 100 million, and she can't recover, that totally damages her brand. And that totally damages what she can do long term and the type of company she can work for. Now that she's going out on top, dude, this lady's going to be able to get a job anywhere. If you're Apple, how many millions do you want to pay her? If you're Meta, it doesn't matter who you are. If you're any brand in the world, you would pay this lady millions of dollars to come over to your company. Any startup, she's going to be one of the hottest commodities. Could you imagine her inbox? Could you imagine her inbox and how many great job offers she has right now? But you got to go out on top. If things are going to start to decline and you stay around on that sinking ship, then you're the one that looks like, oh, you got lucky, or whatever. So she's got to go out on top. So that's my opinion. And the longs are acting like they're not paying attention. It's, oh, no, it doesn't exist. And I'm like, dude, I think you should pay a little attention to this, okay? Alrighty, next up here, Tom Lee.
At Fundstrat, Chief Investment Officer of Fundstrat Capital. Good day to be a bull like yourself, Tom.
Yes, it is.
How do you process what we just heard?
Well, I think that it's the Fed acknowledging that the risks now are tilted for the labor market to be softening, and they want to head that off, especially because they don't think that tight labor markets are going to necessarily create inflation. That's a very good sign, and I think it means we have a dovish Fed again, and that's kind of a green light for small caps.
Small caps
and for equities.
They are working. Last I looked, small caps were up 3%. So is this what we need to really confirm the sort of broadening that comes and goes in the market?
Yeah, because I think that one of the things we should watch for is what happens to mortgage rates. But mortgage spreads are right now 360 basis points higher than the 10-year. Historically, it's 1.6 percentage points. So you could see a huge drop in mortgage rates. That's going to help housing, helps the financial small caps. And I think already the ISM, which has been below 50 for almost 30 months now, could finally go back above 50, and that's a good sign for industrials.
Although we had a discussion right on the heels of the speech about a little steepening in the curve. Is there a sense that the vigilantes are at least present, if not being necessarily vocal?
Yeah, but we could also be steepening because growth expectations are improving as well. So this could be like what I'd call a bull steepening. I'm not really sure what the fixed income terms are, but I think it's actually a positive sign for growth.
The only real losers today are going to be some of the yielders and some staples. Would you be cautious on those?
That's right. I think that markets have been holding their breath. They've been getting defensive. That's why we've been bleeding for 5 days. And so now I think there's a relief and some capital gets put to work, and it's good for equities and risk assets.
So, all right, we need to make some news here, Tom. Everyone listens to you. We're at record highs now for the S&P and the Dow. How much more can these stocks rally?
I think there's a lot of upside, especially because, once you get an ISM back above 50, it really does argue for a broadening of markets. And I think one of the leaders probably comes from the financial sector. So I think, towards the end of the year, 6,800, 7,000 is possible.
Led by tech still?
Yeah, so I think you still want to play
this week.
Yeah, you want to be long AI and the crypto trade because those have been the market leaders. So the Mag 7, Bitcoin, Ethereum. But the broadening is really the financials, industrials, and small caps.
So you like them all?
Yeah, it's kind of cyclicals, AI and crypto, but not the defensives.
Your crypto calls have been getting a lot of attention lately, especially on Ether.
Yes.
Where we were talking earlier, we were debating whether it's the future of the financial system. A lot of people are thinking, people like you have said that.
Yeah, I mean, I think it's a really important moment happening this year with, the Genius Act, really greenlighting stable coins, and then Project Crypto, which is Wall Street moving on to the blockchain. I think it's a lot like 1971 when the U.S. dollar went off the gold standard. That created the innovation of Wall Street because they had to sort of essentially create this synthetic dollar. Wall Street moving on to the blockchain is a bigger moment, and I think that's why Ethereum is essentially having its 1971 moment equivalent.
But a lot of people just see it as wild speculation and fraud.
Yeah, here's the thing. What have I told you guys? You can't get a true peak in the market until you get what? Until you get the small caps to rally hard and you get that blow off top in crypto, right? Once you get that, then you could actually mark a topping in the market and potentially some pain for many quarters or many, even a year or two in the market, right? But you got to get, small caps has been too sleepy. Even during this whole bull run we've had for almost 3 years now at this point in time, you got to get a small cap rally. And the small cap rally, you never know how long it could last. It could last 3 months. It could last 6 months. It could last a year or two, right? It could be an on and off thing where it lasts a year or two, right? Where it's maybe we have initial insane small cap rally, then it takes a breather, then we have another big bull run, right? And then maybe it falters after that. But it's a process, it's hard to call a major top in them. And that's why I didn't get that scared in April, right? You saw me buying stocks left and right in March and April. You didn't see me oh crap, I got to get out all my positions. No, you saw me buying heavily. I wasn't scared at all. 0% scared when all that tariff stuff was going on. You watch all those videos from back then, right? And I'm sure a lot of you guys that are watching this right now, you were watching my videos back then, and hopefully you were able to take advantage of great deals. But I looked and I wasn't scared at all because we hadn't even had the signs of an actual major topping process, which you got to get small caps to roll heavy into a top. And we hadn't even had that. So it didn't even feel oh, this is some multi-year top and we're going to go down in the market for a year or two. Didn't feel like that at all. All it felt was was short-term drama. Everybody's caught up in the tariff drama, Trump, blah, blah, blah. Boom, right back up, right? So anyways, next one up here, the professor. Jeremy Siegel.
It's great to have you here. What do you make of just the emphatic nature of the market response, both equities and bonds? And, especially, I look at this. I look at the massive breadth. I look at the moves in the cyclical parts of the market and the lower quality stuff. It's almost as if this is early cycle and we've been in, a growth scare or something, as opposed to we've already been at all-time highs. So how do you read it?
Well, first of all, I thought it was very dovish. And I think the market reaction is perfectly right. Listen, a small stock's doing so well is textbook. Small companies borrow at the Fed rate, at the Fed funds +1, +2, they are very sensitive to those short-term rates, which now we're going to go down. I wouldn't be surprised to see it 25 basis point in each of the next 3 meetings, down to the low 3s by the beginning of next year. I think it's appropriate. I've been saying that for quite a while on CNBC, that the short rate should be about 100 basis points below the long rate, and that does put it in the low 3s. And I'm not surprised at the reaction, and I think this means more upside for equities.
Yeah, in terms of where the Fed funds rate should be, in my opinion, the Fed funds rate should always be around where CPI is trending. And so let's say CPI on a 3-month trend, 4-month trend is trending 3%, Fed funds 3%. Let's say we've got a CPI trending, for 3 or 4 months straight, right around 2%. Fed funds rate should be right around 2%. We've got a CPI, a 0, which is rare for it to ever be a 0. Fed funds rate should be a 0. We actually had that in the Great Financial Crisis. And I think that was a good time period to have the Fed funds rate at 0 because we had CPI that was around 0 at that particular time, right? If you had CPI at 5%, put the Fed funds rate right around 5%. So that's the way but the Fed doesn't do this. The Fed had us at 4 and 5% for the longest time, Fed funds rate, and still does when we have a CPI in the 2s. And it's just like, why? And then, they had interest rates on the floor for the longest time. We had a CPI go 3, 4, 5, 6, and then they finally started reacting. It's like, oh my gosh, how long are you guys going to wait here? So, no, in regards to the Russell Wilson here, the IWM, let me show you this. I think this is important everybody sees this, okay? Look, the Russell Wilson is lower today than it was in the fourth quarter of 2021, right? So we haven't had that major rally. We got to have a blow off top in the Russell. We got to have this Russell go 3,000 or so before I can become confident, if not 4,000, before I can become confident that, we're going to have a year or two down cycle in the market. You got to have a major blow off top.
I guess the question is, you say you thought that Powell was more dovish than maybe we were led to believe he would be. A lot of folks felt like he would not want to close off various options, right? You have Morgan Stanley, Bank of America. A lot of these big firms do not have a forecast for rate cuts this year, which says to me that there is a relatively robust counter case to the idea that we should be cutting right now. I realize it's at inflection points, you're going to get this disagreement. But the idea that Powell is perhaps going to tolerate cosmetically high headline inflation numbers for the next few months. You think the market can continue to be good with that, even if, let's say, long rates were to leak higher?
Well, first of all, the Fed never forecloses anything for sure. It always does leave that option open. But it's the first time I really heard him say that the tariffs are a one-time increase, and implying that as long as that doesn't spread to other sectors, just, as Steve mentioned, that we should not be looking at that inflation and saying that that's one reason to tighten credit. I've often said, tariffs are like a tax increase. Monetary policy says you should not tighten credit when increased prices is caused by a tax increase. And it seems like pretty much he was on board with that notion. He hasn't seen inflationary expectations go up. My belief is that, the inflation data in the future may not be as important, particularly if it comes from core goods and from tariffs and imports. He'll be looking at the service side of it. And by the way, we know housing is a big part of that service side, and that's been very soft. We see that prices in homes across the country are finally softened to the point of going down, I think, in a majority of states right now. So housing, even though it does get in a lag in the CPI and the PCE deflator, doesn't seem like that big component is going to be a source of that service inflation. So I think that, pretty much that opens the door for those lower rates. And I think that's pretty much the way it should be. And obviously anything can happen, but The market wanted it, and they got it, and it was more clear than I thought he would be, like he was a year ago. The pivot a year ago, we saw it right now. I don't know if it's going to be 50. I think 50 depends pretty much on what the August payrolls are going to be. If we got a negative print, it might be 50. But I think that 25 is certainly in the bag, barring some sort of crisis we don't foresee at the present time.
Yeah, that seems like the safe assumption. And I guess the other...
I got to be honest with you guys. I'm rooting for the market to go down this week. I would love the market to go down big this week. Here's why. So many of these Wall Streeters, are coming on and just being like so bullish and Powell's so dovish and the market loves it and all this stuff. And I think it'd be great if the market was down huge this week. And everybody's just like, then has to go on and like, why is the market down so big? Because they would not know what to say. Like literally, what are they going to flip now and say, oh, maybe Powell was more, hawkish than we thought when we initially listened to it. It's just, oh man, it'd be so good. So yeah, I'm kind of secretly hoping the market goes down big this week. I would love that.
Element of why we're seeing this spring-loaded market response, aside from it being a somewhat more clear message about the likely rate cut, is the setup, right? We spent, several days with the leadership parts of this market selling off, rotating around, a little bit of perhaps a reason to rethink things like the AI trade and whether, in fact, policy was going to remain as restricted as it is right now. So how do you think the stock market continues to digest this in terms of what parts of the market do better?
Yeah, and by the way, when we got those PMIs from, S&P Global, that surprised on the upside. I think a lot of people said, whoa, Powell does have some ammunition to say things are not falling apart. I'm going to be data dependent. That did not deter him. I think that put a little bit more question. I think coming into the week, we thought, he's going to pivot, and some of the data actually was not that weak. We do not see the economy falling apart. We don't see crazy strength by any means. I think that Goldman Sachs and others think 1.5% to 2%. I think the Atlanta Fed thinks 2.5% for this third quarter. That's not a runaway economy. And with the supply of labor being restricted so much by immigration and other policies, as Powell mentioned, any diminution in demand is going to result in negative payrolls and rising unemployment.
Yeah.
Yeah. I mean, people are under the assumption that all the time the Fed lowering interest rates is always good for the market. It's not always. You can even look at last year, they start lowering interest rates and the market actually started to falter right after that, right? You can look at, the great financial crisis, they're lowering rates, and the market just kept going down and down and down and down and down. The economy kept going down and down and down as they kept lowering rates, right? So, I understand people always assume the market's going to have to go up huge when they are cutting interest rate. It doesn't always work that way. Many times the market can go down when they're actually cutting the interest rates. It might get excited before the interest rate cuts come, but many times it actually falters when they're actually doing the interest rates cuts. So it's just something to consider. And we've had a massive move up in the market, without them cutting interest rates anytime recently, right? Something to think about. Markets will move higher until risks show up in the earnings and economy.
The NYU School of Business, they call him the Dean of Valuations for a reason. Oswald, great to have you on. Perfect day for it. Have valuations gotten a little bit stupid, or are we okay?
I think for the last 10 years, we've had this conversation over and over again. When markets reach a new high, we say our market's crazy, and experts like me come on and we say markets are too rich, you got to sell, and 2 years later we repeat the whole process. Over the last 3 or 4 years, I've decided that markets maybe are more trustworthy on this than experts are, that markets seem to figure things out. When you look through this year, there have been two phases to the market. Through April 8th, tech especially was beaten up. The Mag 7 collectively lost, I think, $2 trillion in market cap just in that first 3 months. Between April 8th and today, you look at tech, it's come back. Not just come back, but it's become one of the strongest sectors again, the S&P. So this is a long-standing story, and the story has legs. Is the market rich? Absolutely. Is it underestimating some of the risks that are probably around the corner? Maybe. But given that these risks have to show up in the numbers, which should be in the economy and in earnings, until that happens, I think markets are holding on and saying, hey, we don't know what's going to happen, so we're going to price in the expectation that things are going to be okay.
Do you think the market is overreacting to the Federal Reserve news today?
I think so. I mean, I think I've written extensively about the Fed, and Fed rate cuts not really conveying much to the market other than something for us to all talk about. I mean, they don't even affect the one thing they're supposed to affect, which is interest rates, traded rates. They might affect the Fed funds rate, but Treasury rates themselves have a life of their own. So it'll be interesting to see if there's a Fed rate cut, whether the T-bond rate drops below 4%. My guess is it will not, because as long as inflation stays at 2.5, 2.6, 2.7%, the T-bond rate is destined for 4% plus. So it'll be interesting to see what the bond market does if there's a Fed cut. My guess is it won't do much, and stocks will have to retrace some of the upswing you saw.
So
today.
what do you, okay, fair enough. And by the way, I wouldn't necessarily disagree, as you might have heard at the top of the show. So what do you attribute today to then?
Hey, you know what? The game of expectations keeps getting reset for this market, and sometimes just delivering what was expected becomes an unexpected plus. I mean, it happened with tariffs. The same thing with rates. I think for a period there in the middle, there was worry that inflation would continue.
Listen. How could we forget? Did we not pay attention to what happened in the market before Powell's speech? The market was down like 5 or 6 straight days. The market kept going down. Nasdaq kept drifting down. And so we had a market just kept drifting down. It was fearful of what, and remember what I talked about? It was either this channel or the main channel. I talked about it a few days ago. And I talked about the market now has the storm before the storm. So the event is supposed to be the storm, but the market nowadays has a storm before you get to the storm. And then I was explaining this days ago on the channel, right? Either this channel or the main channel. And I was explaining essentially, Powell's speech, that's supposed to be the big scary storm, right? Meanwhile, the market just kept going down. A lot of stocks were getting hammered because it was already in the storm. Just people didn't realize it yet. And then by the time you actually get to the storm, it's not even scary anymore. We're already at the event. It's like, oh, it's not scary anymore. So, it's fascinating, but that's just what the market does nowadays.
Go up, and rates might continue to go up. I think part of it is expectations keep getting reset, and you beat those expectations, market viewed as a positive surprise. It's a very strange twist on the expectations game, but it is what I think is driving the market today.
Yeah, and we talked earlier in the show about next week we get the Fed's preferred measure of inflation, PCE. What if that were to come in hot? I mean, I read Powell's speech 3 times, Aswath. I'm not, this is the market's going to do what the market's going to do. I'm not here to tell the market it's incorrect. It's not my job. It's obviously interpreting it one way. I don't read the speech the same way the market appears to be. Do you?
Yeah. I don't either. But in a sense, in this case, I think the market views absence of bad news as good news. That Powell did not come in and say anything explicitly about not cutting rates. So I think in many ways, the market is reading in whatever it wants to read into this process. I think the feeling the market.
Exactly. And that, folks, ladies and gentlemen, is why you can never trust the initial move the market makes. Because it will read however it wants on that particular day, and then it can completely flip. And so maybe this isn't one of those situations. Maybe we just rally hard this whole week, and everybody's just flooding money into the whole market this whole week. Maybe that is the case. Or maybe this is like many of these other time periods when we're going to look at the market at this time next week, and it'll be quite a bit lower than where it is when it comes to NASDAQ and S&P 500, the Dow. We'll have to see. As a long-term investor, the great news for us is we don't have to stress about all that, right? We get great deals in the market, sweet, we're going to be buying, right? We have our stocks appreciate and the market just keeps going risk on. We're going to make, it depends on how much money you got, maybe hundreds of thousands of dollars in the next week, millions of dollars, depends, right? Maybe for some folks, a few $100 here and there. All right, guys, appreciate you joining me as always. Thanks so much for being here. If you're looking to get that Patreon sale, we're having it 8 days from now on September 1st. Pin comment down there, click on that, put in your name, email, we'll send over that deal for you, and make sure you create an account with my Patreon. That'll be the next step after this process, so then you can make sure you can receive that deal, and that will be for my highest end Patreon tier in the Patreon, okay? All right, guys, much love as always, and have a great day.